Nowadays, with the stock market doing some wild things in early 2026 and the SP 500 already sitting on an 8% gain for the year, so far there is a lot of renewed interest in investing, and honestly for good reason, because opportunities to build real wealth don't come around every day. If you have been too scared or cautious to start until now, I get it, but watching from the sidelines while inflation eats away at your bank account is a nightmare. Unfortunately, it is not quite as easy as just saying buy all the stocks, because everything feels expensive or the news makes you panic. Every other week investing is a lot like anything else worth doing in life. It is way easier said than done, because emotions and uncertainty always try to get in the way. That's why in this video I wanted to go over the top 7 investing mistakes that beginners make, especially in this current economic limit, because yes, the market is trending up, but that doesn't mean you can just throw all caution out the window and forget the tried and true principles. There is always going to be volatility like we saw back in March, so as you build your game plan for the rest of 2026, here are the traps to avoid. Number 1, by far the most common mistake I see beginner investors make is not even investing at all, because they are stuck in the cash trap. I totally get it. It feels a lot safer to keep your money in a boring bank account instead of seeing it bounce around in the stock market. Cash in the bank gives you this sense of financial and emotional security like nothing else can, and you definitely need some for a rainy day. You should always keep enough cash to cover an emergency, so you don't have to sell your shares during a dip just to pay your bills. However, there are so many people who keep their entire life savings in cash for years, and that is a recipe for a very stressful retirement. The reason why keeping all your money in a bank account is such a bad move is because of our current inflation rate sitting near 4%. Due to inflation, your cash is steadily losing its purchasing power every single day, and that means your hard-earned work is literally melting away. Over the next 30 years, uninvested cash could lose more than half of its value just because the cost of living keeps climbing higher and higher. The dollar has already lost so much purchasing power in just the last few years, which means if you have the same amount of money, everything is pricier. Imagine everything being twice as expensive when you are older and trying to retire on a fixed income. That is the silent kill of wealth. Cash in the bank provides the illusion of safety, but if your money isn't growing faster than inflation, you are actually falling behind. Every month it is like trying to run up a down escalator, and that is why just saving money in a high yield account is never going to be enough to get you free. You have to save your money and then actually put it to work in the market, because that is the only real shot you have at beating the system. I know there are emotional hurdles to overcome, because seeing red numbers on your screen is not exactly a walk in the park for anyone with the volatility we have seen recently. My own portfolio has had some rough days, and it never feels fun to watch your net worth dip. However, I am willing to put up with the ups and downs, because I know the alternative of letting inflation destroy my savings is way worse. If you have never invested before, is going to feel scary to pull the trigger no matter what the SP 500 or the NASDAQ is doing today. The emotional experience of risking your hard-earned money is never going to go away. So I want you to stop making excuses and stop procrastinating. Make a plan, do your research into broad index funds, and get invested, because the cost of waiting is the most expensive mistake you can make. Moving right along to beginner investing mistake number 2, which is not having a solid emergency fund before you start playing the game. Before you put a single dollar into a brokerage account, you need a reserve of cash you can tap into whenever life decides to punch you in the face. Maybe your car breaks down, or you face one of those corporate layoffs we keep seeing in the news, or you just have an unexpected medical bill. These things happen because that is just life. And the last thing you want is to be forced to sell your stocks at a loss just to cover a bill back. When I was younger, I saw firsthand how stressful it is when a family doesn't have a cash cushion during an economic downturn. My parents didn't have an emergency fund, and they had to dip into long-term savings just to keep us afloat, which is a position nobody wants to be in. So this tip comes from real-life experience. Please do not take it lightly, and make sure you have your foundation set. Before you try to build the house, don't try to run before you can walk. Otherwise, you risk sabotaging your long-term gains because you had to liquidate at the worst possible time. The stock market is volatile from month to month. So if you invest $1,000 today, you have to be okay if it looks like 800 tomorrow. In the short run, it yo-yos a lot, but in the long run, the market follows an upward trajectory, and that is where the real wealth is created. You should only invest money that you absolutely do not need to touch for at least 5 to 10 years, so you can ride out any temporary storms. You cannot look at your portfolio like an ATM machine where you can just grab cash whenever you want to buy a new pair of shoes or go on a trip. If you are wondering how big of an emergency fund you need, $1,000 is a great start, but you should aim for 3 to 6 months of expenses. Once you have that buffer, you can start being aggressive with your investments, because you know your basic needs are covered no matter what. The next beginner mistake I see is waiting too long for the perfect moment once you have your debt under control and your emergency fund ready. I see so many people getting ready to get ready, and they spend months analyzing every single chart and news headline without actually buying anything. There is never going to be a perfect time to start, because the market is always going to have some kind of headline that makes you nervous. Theoretically, the best time to buy is at the very bottom of a crash, but nobody knows where the bottom is until it is already in the Rearview mirror, if you wait for the perfect dip, you might miss out on a massive rally like we have seen recently, and then you end up buying an even higher. Hindsight is always 2020, but you cannot build a portfolio on what ifs, so stop trying to time the market and start timing the market. If you are a long-term investor, trying to pick the exact top or bottom is a total waste of your energy, and it usually leads to worse returns. Even if you had a crystal ball and knew the bottom was today, would you actually be brave enough to buy when everyone else is panicking? Market crashes are terrifying, and even seasoned pros get shaky. So the chances of a beginner perfectly timing a dip are basically zero. Be honest with yourself and just get started, because if your financial situation is stable, then you are ready to start building your future. Now I am not saying you should dump every cent of your life savings into one stock on a Monday morning, because that leads us to mistake. Number 4, investing too much money at once before you are emotionally ready for the swings is a huge shock to the system that leads to panic selling. If you are brand new, it is a much better idea to practice with smaller amounts until your nerves get used to seeing the Dale Price movements. Watching $100 move up and down is a very different vibe than watching your entire net worth fluctuate by thousands of dollars in an hour. Start with an amount that lets you sleep at night, and then as you get more comfortable, you can start ramping up your bi-weekly contributions. If you go too hard too fast, you might end up doing something emotional like selling everything during a 5% correction and locking in a loss. Panic sell is the fastest way to stay broke, so the key is to scale up gradually as your confidence and your knowledge grow over time. Once you have trained your nerves, though, you have to make sure you aren't making a mistake. Number 5, which is not investing enough for your goals. According to recent studies, a huge percentage of people are going to struggle in retirement because they didn't realize how much they actually needed. Here is some real talk about the numbers, because if you want to live a $60,000 a year lifestyle in the future, you need a serious nest egg when you factor in inflation. That $60,000 today is going to feel like a lot more in 20 years, so your target has to be higher using the 4% rule. If you want significant passive income, you are likely looking at needing a nest egg of over $1.5 million. I know that sounds like a crazy high number, but with compound interest and a long term mindset, it is actually achievable. If you start now, if you only invest a few bucks here and there using Roundup apps, it is a great start for a habit, but it is not going to get you to the finish line. You need to aim to invest a significant portion of your income every single month, whether that is $500 or $1,000 or more. That leads perfectly into mistake number 6, which is ignoring the impact of taxes on your total returns. Over the long haul, taxes are likely going to be your single biggest expense in your life, so it makes sense to use the right accounts to keep more of what you earn by using a Roth IRA or a 401k. You are giving yourself a massive head start because your money can grow tax-free or tax-deferred. If you are just using a standard brokerage account for everything, you are going to owe a cut to the government on every dividend and every gain. In 2026, the contribution limits for a Roth IRA are $7,500. And if you aren't hitting that first, you are leaving money on the table. Don't just open a random account because an app has good marketing. Make sure you are using tax advantage buckets like a Roth or an HSA. First, just ask any professional investor and they will tell you that tax efficiency is one of the most important parts of their entire strategy. Last but not least, mistake number 7 is not being honest with yourself about how much time you actually want to spend on this. There are so many ways to invest, and they all require different levels of effort, from total autopilot to high stress day trading. The easiest and most effective way for most of us is just buying low-cost index funds that track the whole market and letting them sit for decades. You can expect a solid long-term return without having to spend your weekends reading boring financial statements and balance sheets. On the other hand, if you want to pick individual stocks, you can potentially make way more, but it takes a massive amount of research and skill. Most people do not actually have the time or the interest to do that properly. So don't feel pressured to be a stock picker if you have a busy life. I have gone through phases where I was all about individual companies and phases where I just stuck to index funds because life got busy. The key is to find a rhythm that works for you so you actually stay consistent, because consistency is the only thing that actually builds wealth. If you want to set it and forget it, go with broad market ETFs. And if you want to be more hands-on, then start learning the fundamentals of business. Less of which path you choose, it is always better to be an investor than a spectator, because the world is moving forward with or without you. If you want a shot at a secure future and you want to beat the rising costs of housing and living, you have to get your money in the game. So those are my top 7 beginner mistakes, and honestly, I have made almost all of them myself at some point in my journey. I am just sharing this from personal experience so you can skip the pain and go straight to the gains as we navigate this year together. I hope this inspired you to take a real look at your finances and take that next step toward the life you actually want to live. Thank you so much for hanging out with me today, and if you found this helpful, please give it a thumbs up and subscribe to the channel. I post new videos on money and investing every single Wednesday. So I will see you next week, same time and same place for more real talk. Take care of your money and stay disciplined out there, because your future self is going to thank you for the moves you make today. So let us actually talk about how we can make this happen for you, starting right now with your first $1,000 or whatever you have. The first place to start is to check your retirement options at your workplace, like your 401k plan. Some of you might not have access to this yet, so in that case, you can just focus on your own individual accounts. But A lot of people investing starts with that paycheck deduction where your employer takes a small percentage out automatically before you go off and try to pick the next big tech stock. Make sure you are contributing enough to get your employer match if they offer it. That match is literally a 100% return on your money immediately, and there is no other investment that can guarantee that once you have that rolling. The next step is to open a personal investment account like a Roth IRA at a solid brokerage. Think of this account like a shopping cart. You need to have the cart before you can start picking out the items from the shelves. There are a lot of different accounts out there, but for most of us starting with a tax advantaged, one is the smartest move, a Roth IRA. Let your money grow tax-free, which means when you pull it out in the future, the government does. Take a single cent of your gains once you have the account open and you have transferred some cash into it. You have to remember the most important step, which is actually buying. I see so many people who move money into their account and then just leave it there as cash, thinking they are already investing until you actually click buy on a fund or a stock. Your money is just sitting there in a fancy savings account, not doing much. So when it comes to what to actually buy, I almost always recommend starting with index funds because they are simple and effective. An index fund is just a bundle of hundreds of different companies, like the SP 500, which tracks the 500 biggest companies in the country. It gives you instant diversification, which is just a fancy way of saying you aren't putting all your eggs in one single basket. If one company in the fund has a bad year, it doesn't matter as much because the other 499 are still working for you. This is much safer than trying to guess which individual company is going to be the next big thing, especially when you are just starting out. Look for funds with low expense ratios, because those fees can really eat into your long-term wealth if you aren't careful. You can find great funds that charge almost nothing, and over 30 or 40 years that can save you hundreds of thousands of dollars. Now you also have to think about your asset allocation, which is just the mix between stocks and bonds. In your portfolio, if you are young and have decades ahead of you, it usually makes sense to be more aggressive with a higher percentage in stocks. Stocks have more upside potential, but they also come with more short-term drama and volatility that you have to be able to stomach. Bonds are generally more stable and pay you interest, but they don't usually have the same explosive growth potential as the stock market. Finding the right balance for your age and your personality is key to making sure you actually stay invested when things get bumpy. I personally prefer a very stock-heavy approach right now because I have a long time horizon and I am okay with the roller coaster ride. It is all about knowing yourself and your goals so you don't panic when you see a headline about a market correction or an interest rate hike. Once you have your strategy set, you just need to keep feeding the machine by investing as much as you can, as often as you can. Even if it starts with just $100 a month, the habit of investing is more important than the amount. When you are first starting, compound interest is a powerful force, but it needs time to work its magic. So the earlier you start, the less heavy lifting you have to do. Later, your future self is going to look back at today and be so glad that you decided to stop waiting and start building your legacy. It is not about being a genius or having $1 million to start. It is about being disciplined and having a plan that you actually follow. The world is always going to have reasons to be nervous, but the people who get ahead are the ones who invest through the noise. So take that first step today, open that account or set up that automatic transfer and watch how your life starts to change over the years. You have the power to change your financial trajectory. And it starts with the decisions you make right now in this moment. Thanks for watching and being part of this community where we talk about real money and real strategies for the real world. Don't forget to grab any resources I mentioned in the description, and I will be back next week with another deep dive into your wealth. Stay smart, stay consistent, and I will see you all in the next video for more tips on how to win the money game. Bye.